Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Biogen stock so we can determine if it's a buy or a sell. Biogen is a biotechnology company specializing in the discovery, development, and delivery of therapies for the treatment of neurological diseases to patients worldwide. The company is headquartered in Cambridge, Massachusetts, and was founded in 1978. Let's get started with the model. This is a large cap company, 46 billion market cap. They're trading at $3.10 a share, and they have 149 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a lot of free cash flow in 2019, 6.4 billion. Then that was almost cut in half to 3.7 billion in 2020. It dropped a little in 2021, then cut more than 50% from 2021 to 2022. It's 1.4 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's down 50% from 2019 to 2022. Revenue is the sales for the company, and that doesn't look so good. It's declining each year from 14 billion to 10 billion. They recently released their first quarter earnings, and their revenue is down a little bit from 2.53 billion to 2.46 billion. 1.8 billion is from their main products. They had a negative in Leqembi, 400 million in anti-CD20, and 319 million in contract manufacturing, royalty, and other. Let's dig into these numbers a little bit so we can figure out what they are. Here's a breakdown of the 1.8 billion. 700 million in the US, 1 billion in the rest of the world. Of the 1.8 billion, 64% of that is from multiple sclerosis drugs, 25% from spinal muscular atrophy, and 11% from biosimilars. Biosimilars are very similar to another biological drug that has received FDA approval. So it's like a derivative of another drug. Here's a breakdown of the other revenue line items. They reported a negative 18.9 million from Leqembi. This year in January, the FDA granted accelerated approval of Leqembi. When that happened, they started recognizing profits and losses related to Leqembi. In the first quarter, they recognized a reduction of revenue of 19 million, reflecting their net share of the Leqembi collaboration results. They had 400 million of revenue from anti-CD20 therapeutics, and that's from the drug Rituxan. Anti-CD20 is used in treating the relapse of multiple sclerosis in adult patients. The 307 million of contract manufacturing revenue is from Leqembi. Below that is cost of revenue. These are the expenses directly related to generating the revenue. Then you have R&D 570 million, SG&A 600 million, amortization 50 million. Then they have collaboration profit sharing. Because say for instance they work with another company to come up with a drug. And if that other company, Biogen, decided that Biogen would have 80% of the revenue and the other company 20%, then when Biogen receives the money, say they received $100 million, they have to give $20 million to that other company, their share of the profits. So they record that expense on their income statement, and they call it collaboration profit sharing. They're sharing the profits. We have 10 million of restructuring, and then other 70 million. So total expenses are 2 billion, down a little from last year. 51 million of taxes, so their net income is 388 million, up a good amount from last year of 300 million. The reason it's up because they paid a lot more taxes last year, 125 million. 70 million more in taxes. Their EPS improved from 206 to 269. And it looks like they're buying back stock. They had 147 million shares outstanding in 2022. In 2023, it's 144.4 million. Let's look at the capital structure. 13 billion of equity, 7 billion of debt. They're 2/3 equity, 1/3 debt. And their net debt is 1.7 billion. So they have about 5 billion of cash on their balance sheet. I gave them a whack of 7.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's 65 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $59 billion. We divide that by 149 million shares. And we get a calculated stock price of $3.94. They're trading at $3.10, so they're trading at a 21% discount. It's a buy according to the model. Simply Wall Street's at $3.94. They're saying the stock is 21% undervalued. 23 analysts priced this stock, and the average price target is $3.30. The low is $2.63. The high is $3.80. 27 more analysts priced this stock, and the average price target is $3.34. They say it's 8% undervalued. This is where the stock has been trading the last 30 years. So you can see they did two stock splits, one at the end of '99 and one in the beginning of 2001. They did grow a lot from '93 to 2000. Then from 2000 to 2010, they traded sideways. Then starting in 2010, it skyrocketed from 50 to 500. It took about 5 years for the stock to multiply by 10. And it never reached that point ever again. It did get down to below $200 a few months ago, but quickly ran back up to over 300. I have a feeling they're going to be trading sideways for a long time. This bottom chart pinpoints their quarterly revenue. In the most recent quarter, in the first quarter of 2023, it was $2.5 billion. They got close to $3.6 billion in the first quarter of 2020. They were also really high in 2019. But that was their glory days. The revenue has retracted in the past couple of years. It's interesting to see because 2015 is when the stock peaked and their revenue was just climbing. Their revenue peaked in 2020, and by that point, the stock has already come down about 40-50% from its peak. There are 15 companies in the same industry as Biogen, and if Biogen has a number in red, they're worse than the median. If they have a number in blue, they're better. They spent $320 million in capex, a lot less than the median. They have a good debt-to-equity ratio. For every dollar of equity, they have 50 cents of debt. They're one of the few companies on this list that do not pay a dividend. They only generate $1.4 billion of free cash flow. They rank 13th out of the 15 companies in market cap. They do have a good price-to-book and PE ratio, but not such a good price to free cash flow, and their price sales is average. Their revenue is a lot lower than average, and they're one of the few companies that are declining in terms of revenue. Their 5-year annual revenue growth rate is -4%. So to summarize, I have them trading at a 21% discount. They've been around 45 years. Unfortunately, they've never paid a dividend, and the trajectory of their free cash flow doesn't look like they're going to pay one in the near future. So it could be a good time to get the stock at somewhat of a discount, or you might want to wait for it to come down even more. I rank their free cash flows 2 out of 10, their revenue and ratio is 5 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to be a member, click on the link in the description below. Thanks for watching.